Good evening, everybody. Thank you very much for joining in. This side, Rahul Magan here as the Chief Executive Officer of Treasury Consulting LLP. And today we are going to cover a very interesting video about the growing role of emerging economies across the globe. Unfortunately, we still tend to bear that growing economies are very good for the global growth, but they are much laggard than when it comes to the developing of the developed economy, especially US and all. But that is not true. According to the latest research which has published recently in the month of October, the things by the which is International Monetary Fund World Economic Outlook database, the things are totally different versus what we expected to believe. And due to the time and space issue, we are not in a situation to cover country by country. But here, what we are doing, we are covering the complete example or the complete cycle of of the research report which has been published by International Monetary Fund. If you look at this report carefully, which is right in front of you, then you will get to know that the first chart which you're getting, which is chart number one, you will get to know that the emerging market growth is picking up. Now, what exactly is that? If you look at this chart, I will put the pointer here, which is chart number one here I'm talking about. Then you will get to know that advanced economy are contributing approximately four. This is emerging market growth is picking up. So emerging market is growing at the rate 4.76. You take it approximately 4.8, and while on the other hand, emerging advanced economies are growing at the rate of 1.82. The aforesaid chart has been taken from the World Economic Outlook 2016 by International Monetary Fund, which is a public report. And also, the particular GDP has been computed on the constant basis. So it has not computing on the notional; it is computing on the constant basis. This is a very surprising fact, and we sincerely need to understand that how this exactly it is happening. When the when the emerging setup is growing by 4.8 roughly, and advanced is going by 1.82, this seems to be very good. At the same time, while taking this chart and especially talking about India and some other countries also, we should not forget that there is a huge manipulation in the GDP numbers which is happening, because the actual reality in the market on the ground is far different from the GDP numbers because of the base effect. So we also need to see the base effect also. Although it is very encouraging sign that advanced economies are growing by roughly 1.82, while our emerging are growing by roughly 4.76. But we should take into consideration of the fact that the probability of manipulating in the GDP as well as the inflation number cannot be discounted. That is something which we seriously need to understand, because we are living in the time when anything can happen. Anything can happen. Chart number two, you this is a very important chart, and you should see that this clearly suggests that advanced economies. If you look at this chart, then you will get to know. Let me increase the size a little bit. Then you will get to know that advanced economies are now contributing more than approximately 60% of the world GDP, which is three fifth of the world GDP, which is a very high number, because three-fifth of the world GDP means you are contributing 60% of the total gross domestic product of the globe, which is very high. Now, if you look at this chart, I'm just reducing the size a little bit, then you will get to know that in 1990, it was the same situation with the developed world when they contributed approximately 63%. From 1990 till 2018, they had reduced from 63 to 40%, and emerging economies who were at roughly 36% increased to 60%. But there is a caveat in this data. The caveat is that the data is computing on the purchasing power parity. That is something which we need to understand. Gross domestic product is different when computed on purchasing power parity, and it is different when we computing on the factor prices or the notional prices. And the perfect example is Tokyo, in the sense, oh sorry, China. If we take the Chinese GDP number wise, then we will get roughly approximately $16.5 trillion of number. $16.5 trillion is a solid number, right? We should not 16.5 trillion is a solid number. But if we take into account, your purchasing power parity, then you would get to know that China is the number one economy of the globe, even greater than the US. So there is a great difference between purchasing power parity and the real value of the particular number of the particular country. And this particular figure, which has been suggested by the World Economic Forum, World Bank, International Monetary Fund, they suggested this. They suggested the same using the purchasing power parity. So few things, something which we need to take into consideration very seriously. Chart number 3, which is a very good chart also. Emerging markets have hugely outperformed the developed market in terms of indices. Indices being Morgan Stanley Emerging Market Index and Morgan Stanley World Index. Right up front you, I'm just resizing the screen. You will get to know that Morgan Stanley Emerging Market Index is approximately 911, and on the other hand, Morgan Stanley Emerging Market to of the world is 417. It means things are very going good for emerging market, but at the same time we should not forget that majority of this number, majority of the emerging market number is moving around China. So that should not be discounted, or that should not be taken into consideration, that the all economies are contributing in the same way. Like Brazil is in an issue, Indonesia is facing an issue, and there are a lot of things which we have. So majority of the numbers when it comes to the emerging economies, they are to an extent moving around China. Fourth chart, which is also a very good chart, which suggests that investment in the developing world continues to be robust. Now, the developing nations are contributing approximately, the investment to GDP ratio is roughly 32%. On the other hand, in developed world, this is approximately 20.86, or roughly 21%. But here is a caveat in this chart as well. The caveat is the carry trade. Now, sitting today, approximately 14 to 15 trillion dollars of the sovereign bonds are having negative interest rate parity. We suggest that you are investing 100 euro, and at the end you will get 99.8 euro. It means you are paying to government rather than receiving it. Henceforth, it is very difficult for the corporates to invest in developed nation. And if you look at one more chart which was shared by Bloomberg, although we are not presenting this chart here, this chart clearly suggests that sitting today there is a dry powder of $50 trillion across the globe. Now, what do you mean by dry powder? Dry powder stands for the total amount of cash the investors are having, but they are not investing. Why they are not investing? Either they are not getting any opportunity, or they are not sure about the opportunity, or they are not convinced with the opportunity. But in all the three perspectives, sitting today more than $50 trillion of our cash is lying vacant in the hands of an investor. And assume if out of $50 trillion, even one tenth will come in the market, lot of indices will move up, and lot of stuff would change. So there are few things which we need to see. Fifth is a very debatable point, and I would tend to little bit disagree with this, but still it is a chart which World Economic Forum is showing, so we are presenting here. They are saying that advanced economies, the inflation of the emerging economies is also coming down. I would tend to disagree with this, except China, because China is a country where for the last 30 years inflation is between 2 to 3%, which is very good. Henceforth, if you look at China, you will get to know that the incremental capital output ratio is China is very good. It is, I think it is 2.5 to 1. Now that 2.5 to 1 incremental capital output ratio suggests that you need to invest $1, and in return you will get approximately $2.5. Now, if we compare this with India, then you would get to know that the incremental capital output ratio is roughly 6.5 to 1. Because there is no data which I have today, I think over the period it might have turned higher. But in the absence of any data, it is very difficult to comment, to be very honest. Henceforth, chart fifth is where Treasury Consulting LLP is not been able to give any view, because we don't agree with the way the developing nations are presenting their inflation. The perfect example in India. If you look at the India, then they are saying that their WPI is negative and CPI is between 4% plus minus 2%. Is that right? Definitely not. This is not right. So there is a lot of caveats which we need to consider. But yes, sixth is very good, and there is a caveat that we'll discuss after this. They are saying that the volume of exports of goods and services of emerging economies is going up. There is no doubt about that, and I think this would certainly move up. But again, there are two caveats that we need to discuss. Number one caveat is that the data which you looking all the six charts when it comes to the emerging, the China is a part of that. If we exclude China, then we'll get the real picture. And second is that effective last 10 years, the world trade has grown over 3%, so which is approximately 0.3% per year. This is the report which has been given up by the World Trade. This is the report which has been given up by the World Trade Body, and this is a very dismissal report that you growing by 0.3% per year. But nonetheless, in all considerations, emerging economies are picking up. Of course, they need to because developed economies are failing. I think central bank contributed a lot in this. In the sense, like central bank did a huge amount of quantitative easing, which not only created the financial inflation but also slowed down their economy a little bit. And a very surprising factor is that Central Bank of Tokyo, which is back in Japan, is still considering the probability of having the probability of having another set of quantitative easing, and Swiss National Bank Thomas Jordan has clearly said that in case required, then we are willing to go ahead to cut the rate. So this is a little point of conflict we have, but overall, if we look at the chart two again, then we will get a very best picture that this is a very rosy and very convincing picture that that the developing economy is having 60% of the world GDP, which is good. And I think this is good in the sense like if the next financial crisis would happen, then world would not be much relied on the developed nation like what we had in 2008. Of course, the world is due for another big financial crisis. We're not sure when it would happen, but surely it would happen. Probably in the next 2 3 years. So this was the total. This was the topic for the today. When we let you know about emerging market and advanced economies, the few data indicators, and hope you like this video. Over the period, we would contribute a lot of videos to you. Thank you, and have a great job and have a great day ahead.